Good day, everyone. To today's session, we're to embark on a journey into the heart of financial operations, the world of financing, the sources of funds. In our previous lesson, we've laid the groundwork by exploring the intricacies of working capital management, from understanding its components to the tools at our disposal. Today, we're about to connect those dots and witness how financial institutions, particularly banks, play a pivotal role in shaping the financial landscape of businesses. Before we proceed into our new lesson today, let's take a quick trip down memory lane and revisit some key concepts we explored in our last session. In our previous lesson, we delved into the intricacies of working capital and its various dimensions. Here's a brief recap. Working capital. We discussed how working capital is the lifeblood of a business, representing the operational liquidity necessary for day-to-day activities. Second, positive and negative working capital. We explored the implications of having excess or insufficient current assets to cover current liabilities. Third, temporary and permanent working capital, differentiated between the cyclical and structural components of working capital. Fourth, working capital financing policies. We explored strategies such as maturity matching, aggressive and conservative approaches to ensure optimal funding. Fifth, calculating operating cycle and net operating cycle. We introduced metrics like days inventory outstanding, days sales outstanding, and days payables outstanding to measure efficiency. Last, tools in working capital management. We explore the tools at our disposal, such as cash management, receivable management, and inventory management. Now, why is this recap important today? Well, understanding these concepts is like having a toolkit for effective financial management. As we shift our focus to today's lesson, it is crucial to recognize that these tools and concepts are interconnected. Banks play a pivotal role in the financial ecosystem, influencing how businesses manage their working capital. For instance, the decisions we make regarding working capital financing policies can significantly impact the types of financial services we may seek from banks, whether it is short-term loans to manage cash flow or long-term financing for strategic expansion. The choices we make are intricately linked to the principles we discussed in our previous sessions. So, as we embark on today's lesson, keep these working capital concepts in mind. To start off, we will start with real world examples to pique your interest and set the stage for our discussions. I have provided you with two news articles that touch on recent financial development in the business world. I want each of you to take a few minutes to read these articles and think about the questions I will be asking afterward. Let us focus on these two articles. While reading the articles, jot down your thoughts on these questions. This will help us set the stage for our lesson on financing. Once you're done, we will come back together and discuss your findings. These real-world examples will provide a practical context for the concepts we'll be exploring today. Our goal for this lesson is to define and distinguish banks and non-banks, define financing and differentiate between equity and debt financing, explore the advantages and disadvantages of debt and equity financing, and identify various sources and costs of short-term and long-term financing. Let's start with definition of terms. In the Philippine context, the terms banks and non-banks generally refer to financial institutions that play different roles in the financial system. Here are the definitions and differences between banks and non-banks in the Philippines. Banks in the Philippines are financial institutions that are authorized to accept deposits, extend loans, and provide a variety of financial services. Banks are regulated by the Bangko Sentral ng Pilipinas, which is the central bank of the Philippines. There are different types of banks in the Philippines, including universal banks, commercial banks, thrift banks, and rural banks. Each type has specific functions and limitations. Like, for example, universal banks. These are banks that can engage in a wide range of financial services, including commercial banking, investment banking, and trust services. We also have commercial banks. Commercial banks are banks primarily engaged in obtaining funds from the public through deposits and providing loans and other financial services. We also have thrift banks. These are banks that focuses on promoting savings and thriftiness. They can cater to retail and small and medium-sized enterprises and typically offer services such as savings accounts and small business loans. Rural banks. These banks are primarily located in the rural areas and focus on serving the financial needs of the agricultural sector and local communities. Non-banks, on the other hand, include a variety of financial institutions that do not have a full banking license but still provide financial services. These institutions are also regulated by the Bangko Sentral ng Pilipinas. Non-banks can include entities such as non-bank financial institutions or the NBFIs. These institutions include finance companies, investment houses, and other entities that provide financial services but do not have a banking license. Microfinance institutions. These institutions focus on providing financial services such as small loans to micro entrepreneurs and individuals in low-income communities. Pawn shop, while not traditional banks, the Philippines, pawn shops in the Philippines play a significant role in providing short-term loans secured by personal property. We also have remittance companies, entities that facilitate the transfer of funds from overseas Filipino workers to their families in the Philippines. The main difference between banks and non-banks lies in the scope of services they can offer. Banks, depending on their type, have a broader range of financial services and can generally accept deposits and provide a wider array of financial services. Non-banks, while also offering financial services, may have more limited functions and typically do not have the authority to accept deposits. It is important to note that both banks and non-banks are crucial components of the financial system, each serving specific needs and segments of the population. To start with, let us define what financing is. Financing is the process of funding business activities, purchases, or investments. It is essentially how a company raises the money it needs to operate, expand, or invest in various ventures. So when a business needs capital, it looks into financing options to get the necessary funds. For example, a company is expected to perform well. You can usually obtain debt financing at a lower effective cost. For example, if you run a small business and need 40,000 pesos of financing, you can either take out a 40,000 pesos from a bank loan at 10% interest rate, or you can sell a 25% stake in your business to your neighbor for 40,000 pesos. Suppose your business earns a 20,000 pesos profit during the next year. If you took the bank loan, your interest expense, and that is the cost of debt financing, would be 4,000 pesos, leaving you with 16,000 pesos in profit. Conversely, if you used equity financing, you would have zero debt and as a result, no interest expense, but would keep only 75% of your profit and the other 25% that is being owned by your neighbor. So therefore, your personal profit would only be 15,000 pesos or the 75% of 20,000. Choosing between equity and debt is one of the most common decisions made by business managers while raising capital. These are the two main sources of capital for any business. Equity is the form of capital raised from investors in exchange for a share in ownership of the business. Equity refers to a stock or an other security representing ownership in the business. On the other hand, debt is the loans taken by the business from banks which must be repaid along with interest. The debt can be long term or short term depending on the needs of the business. What are the advantages and disadvantages of debt and equity financing? Now, let's break down the advantages and disadvantages of each. Advantages of debt financing: interest payments are deductible. Interest paid on debts is generally tax deductible, providing a financial advantage. No dilution of ownership. The company retains control. By opting for debt financing, the company borrows money but doesn't give up ownership. Ibig sabihin, nananatili ang control over the business operations at ng decision process ng negosyo. Disadvantages of debt financing: obligation to repay regardless of the company's financial performance. The obligation to repay the borrowed amount remains. This fixed commitment can become challenging, especially if the company faces financial difficulties. Interest payments can become significant financial burden. While interest payments are tax deductible, they can still become a significant financial burden, especially if the interest rates are high or if the company's earnings are not sufficient to cover these payments. Advantages of equity financing: no obligation to repay. Unlike debt financing, there is no obligation to repay the invested capital. This can be particularly advantageous during challenging financial periods when the company might struggle to meet debt obligations. Investors share in the risk. Investors in equity financing share in the risk of the business. If the company performs well, investors benefit. If it performs poorly, they share in the losses. Potential for valuable business advice from investors. Equity investors often bring more than just capital. They may provide valuable business advice, industry connections, and expertise, in contributing to the company's growth and success. Disadvantages of equity financing: dilution of ownership. Existing owners have a smaller share. Equity financing involves selling ownership stakes in the company. This leads to dilution, meaning existing owners have a smaller percentage of ownership. This can be a downside for entrepreneurs who want to maintain control over their business. Sharing profits with investors. Unlike debt financing, where the company only pays interest, equity financing requires sharing profits with investors. This can be a long-term cost, especially if the business becomes highly successful. Is equity financing riskier than debt financing? Debt financing and equity financing both have their own advantages and disadvantages, and it is difficult to say which one is riskier than the other. It depends, maybe, on the specific circumstances of the company. Debt financing can be riskier if the company is not profitable, as there will be a pressure from lenders to repay the loan. On the other hand, equity financing can be risky if investors want the company to make a big profit, as they may try to negotiate for lower cost shares or divest entirely. However, equity financing may be less risky than debt financing because there is no obligation to repay the money acquired through it, and investors typically think long term and do not expect a quick return of their money. Ultimately, the decision between debt and equity financing depends on the variety of factors such as the current economic climate, the company's existing capital structure, and the business life cycle stage, and the like. Debt financing can be short-term financing or long-term financing. Short-term financing refers to the process of acquiring funds to cover short-term needs or obligations. These are typically financial requirements that can be resolved within a year or less. Short-term financing is vital for things like managing operational expenses, meeting unexpected cash flow gaps, or taking advantage of opportunities in the short term. And this short-term financing can be secured or unsecured. Secured credit means that the funds borrowed are backed up by a collateral in which a specific asset is pledged in the event that the amount borrowed, including the interest and penalties, are not settled. Unsecured loans financing granted without a specific asset used as a collateral. Long-term financing refers to the process of acquiring funds to cover long-term needs or obligations. These are financial requirements that extend beyond a year, such as funding for major projects, capital expenditures, or ongoing business operations. Unlike short-term financing, which addresses immediate needs, the long-term financing is about securing capital for the future. Now, we will be examining the sources and costs of short-term financing. Understanding these concepts is crucial for businesses to effectively manage their finances and make informed decisions. First source is the accrued expenses and deferred income. Accrued expenses and deferred income are two sources of short-term financing. Accrued expenses are expenses that have been incurred but not yet paid, while deferred income is income that has been received but not yet earned. These sources of financing are often used by businesses to manage their cash flow. Halimbawa ng accrued expense. A service-oriented company is having a large expenses para sa isang project. So, sa halip na bayaran agad-agad lahat ng mga gastusin para doon, maaaring i-record ito bilang accrued expenses sa kanilang financial statements. Ibig sabihin, i-recognize na nila ang gastusin kahit hindi pa nila ito babayaran or binabayaran. Ginagamit ito upang maipagpaliban ng pagbabayad ng gastusin at mapanatili ang sapat na cash flow sa kasalukuyang panahon. Sa ganitong paraan, maaaring gamitin ng kumpanya ang pera nito sa ibang mahalagang aspeto ng operasyon. Sa deferred income naman, halimbawa, ang isang kumpanya ay nakatanggap ng advance payments from their clients. So, the received payments is deferred income since hindi pa fulfilled ng company ang serbisyo o hindi pa nadi-deliver ang goods na ipaprovide dapat nila sa clients. Ang deferred income ay magbibigay daan sa kumpanya na magkaroon ng immediate funds kahit na hindi pa natatapos o naibebenta ang produkto. Ito ay maaaring gamitin para sa ibang proyekto o pangangailangan ng kumpanya sa kasalukuyan. Sa parehong halimbawa, ang accrued expenses at deferred income ay nagbibigay daan sa kumpanya to manage cash flow by adjusting the recognition of income and expenses in the company's financial statements. Second is the supplier's trade credit. Supplier's trade credit is another source of short-term financing. This is when a supplier allows a business to purchase goods or services on credit and pay them at a later date. This is a common practice in many industries, and it allows businesses to manage their cash flow more effectively. Imagine a retail business gearing up for a holiday season, anticipating a surge in customer demand. In this case, maaaring kumuha ng paninda mula sa mga supplier sa pamamagitan ng utang at babayaran ang mga ito at a later date nang hindi kinakailangan agad maglabas ng pera. By adopting this approach, the business can not only fulfill increased customer orders, but also maaari rin itong kumita nang hindi naapektuhan ang cash flow ng company. Bank loans. Bank loans are another source of short-term financing. This is when a business borrows money from a bank and agrees to pay it back with interest over a set period of time. Bank loans are often used to finance short-term projects or to manage cash flow. For example, a business may need to purchase new equipment to meet customer demand, but they do not have enough cash on hand to pay for it. In this case, they may use a bank loan to purchase the equipment and then pay it off over a set period of time. Next, commercial papers. Commercial papers are another source of short-term financing. This is when a business issues short-term debt securities to investors in exchange for cash. Commercial papers are often used by large corporations to manage their cash flow. For example, a large corporation may issue commercial papers to investors to raise cash to pay for short-term expenses. Next is pledging of receivables. Pledging is another source of short-term financing. This is when a business pledges its accounts receivable as collateral for a loan. For example, a business may pledge its accounts receivable as collateral for loan to purchase new equipment or to pay short-term expenses. Next is factoring of receivables. Factoring of receivables is another source of short-term financing. This is when a business sells its account receivable to a third party known as factor in exchange for cash. The factor then collects the payments from the customers and takes a percentage of the payments as a fee. For example, a business may sell its accounts receivable to a factor to raise cash to pay for short-term expenses. There are various sources from which businesses can obtain long-term financing. Let's explore a few of the most common ones and their implications or cost. Long-term debts. Long-term debts involve borrowing money that needs to be repaid over an extended period, often several years or even decades. These debts can include bonds, mortgages, or loans. Companies may issue bonds to the public to secure loans from financial institutions to finance their long-term projects. The cost of long-term debts involves interest payments and sometimes additional costs associated with issuing bonds or arranging loans. It is essential for companies to manage these obligations efficiently to avoid financial strain. Next, preference shares. Preference shares are a type of equity financing, but they come with certain preferences. Holders of preference shares received fixed dividends before common shareholders. They offer a mix of equity and debt characteristics, providing companies with capital while avoiding the obligations of interest payments. Preference shares require paying fixed dividends to shareholders. These dividends represent a fixed cost, and companies must ensure that they have sufficient earnings to meet these obligations. Next, ordinary or common share. Ordinary or common shares represent ownership in the company. Shareholders are entitled to a portion of company's profits and have voting rights. Issuing common shares is a way for a company to raise capital by selling ownership stakes to investors. Issuing common shares dilutes the ownership of existing shareholders, but it doesn't involve direct financial obligations like interest payments. It is essentially sharing ownership in exchange for capital. Next is retained earnings. Retained earnings are accumulated profits a company has retained rather than distributed to shareholders as dividends. Companies can use these earnings to finance future growth or operations without taking on additional debt or selling more shares. There is no direct cost associated with retained earnings. It is using the company's own profits to fund future endeavors. However, there is an opportunity cost as these funds could have been distributed as dividends to shareholders. Now, to deepen our understanding of long-term financing and how it applies in the real world, I'd like to present another news article that sheds light on a practical scenario. This article titled Why Apple Raised $6.5 billion in Debt discusses Apple's decision to issue debt. After we go through it, I will ask you to share what you have learned. Now you're done reading it, answer these questions. Why did Apple decide to raise $6.5 billion in debt? What was the rationale? How might the cost of debt financing compare to the potential benefits for Apple? What are the implications of this decision for Apple's long term financial strategy? Do you think this is a common practice among large corporations? If so, why? Now, I'd like you to consider the broader implications of these financing options in the business world. As you've learned, whether a company chooses equity financing or debt financing can significantly impact its operations and growth. Equity financing often means sharing ownership and potential risk with investors, while debt financing involves obligation to repay borrowed money. These financing decisions have far reaching consequences in the business world. For example, they can affect a company's ability to expand, innovate, or weather financial challenges. They can also influence the relationships between a company and its investors or lenders. So, I encourage you to think about the following questions. How do financing choices impact the strategic direction of the company? What factors should a business consider when deciding between debt and equity financing? How would you relate this topic to your everyday life as a student? As we conclude today's lesson on financing, I want to express appreciation for watching until the end. We've delved into the world of financial decision making, exploring concepts that are not only crucial for businesses but also have real world applications in your personal lives. Understanding financing empowers you to navigate financial landscape whether you are managing your allowance, planning for future goals, or making more informed decisions as you transition into adulthood. Remember, finance is not just a numbers, it is about making strategic choices that align with your goals. As you apply these concepts, you're not only gaining knowledge but also developing practical skills that will serve you well in various aspects of your life. Until then, keep exploring, keep questioning, and most importantly, keep applying what you've learned. Have a wonderful day. Thank you. As we wrap up our lesson on financing, I want to provide you with an assignment that will help reinforce your understanding of the concepts we have covered. It is also an opportunity to apply what you've learned to real world scenarios. This assignment involves researching and comparing loan requirements and options from various local banks and non bank financial institutions.